All right. Hello, everyone. Happy Monday. Welcome to your weekly market check-in here with myself, Greta Wall. I'm your host, and I'm joined by Derrick Oldensmith, the head trader at T3 Trading Group and the leader of T3 Live's Pro Desk virtual trading floor. Before we get into any market-related discussion, here's a quick disclosure of Derrick's current positions as of our recording here today on September 15th. 2025. The title of our stream today, Derrick, is Countdown to the Fed, because of course everyone's eyes are on Wednesday at 2 p.m. Eastern, maybe a little bit more 2:30 p.m. Eastern. But here on Monday, how is your trading day going so far?
Not great. I'm down some P&L. I'm pretty short this market. I'm probably like slightly early. Obviously, we're talking about the Fed today, so we can just jump right into it. I have really high conviction right now that this Fed is like a buy the rumor, sell the news event, and that we are currently right now in the buy the rumor phase of it. We've been in that really, starting last week when we saw further deterioration in some of these economic numbers. I mean, when it came to like the PPI and the CPI, the CPI was very in line. We are seeing inflation increasing, but the CPI was very in line. So that wasn't bad enough in terms of inflation accelerating to slow down the Fed. But coupled with that, we saw a really bad unemployment claims report. That's right after the bad non-farm payrolls report. So this is like Goldilocks for Fed cutting. It's not necessarily Goldilocks for the economy. The economy is deteriorating. The economy is dealing with slowing growth and higher inflation at the same time, although that higher inflation is relatively under control. Core is up to 3.1%, which is a little bit concerning. But it's like Goldilocks for Fed cutting. So the market right now is really, really pricing in those Fed cuts. They're pushing them all forward. 3 cuts for 2025, probably another 2 cuts in early 2026. So we've got 5 cuts that the market's really pricing in on the horizon. What we're going to see on Wednesday with the Fed is a 25 basis point cut. I'm extremely confident of it. The question mark isn't really the cut. Maybe some people are questioning on whether or not we could get a 50 basis point cut. I would say it's extremely unlikely. We're going to get 25 basis points. So the question mark isn't the cut. The question mark is how hawkish or dovish are they around that cut? And at this point, I think that the market is pricing in like maximum dovishness, 25 basis point cut for September plus dovish language plus a dot plot that shows that we're getting 2 additional cuts after September in 2025 and 2 in early 2026. So therefore, I think that the market's set up for disappointment. I think that the best case situation now for the Fed is priced in with where we are currently trading right now. And if you see any language that is remotely hawkish from Jerome Powell, remotely in the realm of, hey, that inflation is still ticking up, our target's 2% and we're at 3.1% with core. So, we're not going to be in a rush for huge cuts. If you see anything like that, then I actually think that the market's going to get destroyed on it. So for me right now, I have high conviction. We are in a buy the rumor, sell the news event. We're buying this market up to front run those Fed cuts right now. But when the Fed cut actually occurs, if you get a dovish cut, maybe the market shoots up briefly, but I don't think it'll be able to hold it. And if you get a hawkish cut, then the market's going to get absolutely destroyed. And that's right as we're coming into expiration and options expiration. So it's happening. This event is happening at a perfect time in terms of market dynamics and flow of funds to actually be able to set up a more major sell-off in this market if selling occurs. So in other words, if you were to get I think there's a lot of downside risk here. If you were to get a hawkish cut that sends the market down, we are at a spot pretty much perfectly with timing as we go into the back half of September, where selling can accelerate into more selling and systematic community begins to sell and everything accelerates and we get our first bigger sell-off since the April bottom.
You obviously are not the only person who's saying this is a sell the news event. I'm of course seeing that from multiple other traders in our circle here at T3, traders on Twitter, etc. Because everyone seems to be kind of in that consensus. Does that change it at all for you that, maybe it might not actually be a sell the news since everybody's expecting it to be a sell the news event?
No, it honestly doesn't, because market dynamics and market flows, they just are what they are, regardless of what people are saying. If I could point to anything that I still think is potentially bullish, one is that sentiment is remarkably low for where the market actually is. All-time highs every day, yet sentiment remains really low. And long short positioning from like the hedge fund and institutional community, while it has gotten more long, it's not like it was back in February where we were seeing hedge funds long at the 97th percentile on a 5-year look back. It's not that, because they have been a little bit more rational, a little bit more disbelieving of this market, which has honestly led to underperformance because the market's been so strong. But what that means is that they don't have the same level of stock to have to puke out into a downside move. And in fact, they have shorts that they can cover, and they have ammo to buy dips on the way down, and that can steady the market a little bit. But I think when you look at the other cohorts that are out there, in terms of you get into the back half of September, I really like to think about the market in terms of technical analysis, but I also like to think about it in terms of what we call flow of funds or market dynamics. And when I think about flow of funds, basically what you have is these different major cohorts of buyers or sellers that can be in the marketplace. And those cohorts include retail money, institutional money, hedge fund long short money, systematic community money, which we spent a lot of time talking about. Corporate buybacks is like another huge one. And then there's some other structural stuff related to like market gamma and things like that. And when I think about all of those potential flow of funds, the systematic community, the risk right now is 100% to the downside. They are fully in the pool. They don't have anything left to buy. And if the market were to sell it, it could feed on itself. September is historically a month where retail does not buy as big. So they may still be on the bid, but they're probably not buying as big. Corporate buybacks, which is one of those cohorts, they're entering into their next into it as we get towards the beginning of October. So you're losing the corporate buyback bid. So, when you think about all of those different cohorts and you ask yourself, well, who is there that is actually left to be able to buy this market, which, by the way, we're trading at it's a pretty expensive market. Who's left to be able to buy this market? Again, it is some degree of the retail community. They seem to have a never-ending bid. It will end if employment starts to worsen. And to some degree, that institutional long short group. But everybody else out there, they're either stopping their buying, slowing down their buying, or into a down move could become big sellers. The question is, can the Fed actually act as that catalyst? And I don't fully know. I think it's really going to depend on the language that's around the Fed. And I think that there could be, the market, like I said before, is not just pricing in these cuts. They're pricing in dovish language around those cuts. And I think that you might see a Fed that is still more neutral or even slightly hawkish sounding after seeing core CPI tick back up to 3.1%. And if you see that, we sell.
Yeah. The market definitely wants Powell at 2:30 to be like, everything's falling apart. More and more cuts are coming. We're ignoring inflation because it's so bad over here, etc. So that's definitely But I don't think they can.
And it just shows you that the stock market's not the economy, right? Because the economy is clearly deteriorating, but Fed cuts, the market looks towards the future. Fed cuts can provide a lot of stimulus with where we are, and therefore market participants have continued to buy this market up despite a weakening picture.
All right. Just a quick reminder for everyone who is with us here live. If you have any questions for Derrick or any specific tickers you'd like him to take a look at, any charts, go ahead and put those in the comments, whether you're on YouTube, Twitter, X, etc. And we will get to those at the end of our discussion here. All right. I wanted to get your opinion on an interesting storyline that was out today from the president in a Truth Social post this morning. President Trump floating the idea of companies no longer providing earnings reports on a quarterly basis, instead saying they should go to, I think, semi-annual is what he said, saying, of course, the idea would be subject to SEC approval. but claiming it would save money and allow managers to focus on properly running their companies. As a trader, would you like semi-annual reports over quarterly reports, or do you like the current structure?
So first of all, this is a comment from President Trump that I generally agree with. I've seen studies going back, years ago now that really show that because these S&P companies have to report quarterly, their entire focus is quarter to quarter to quarter to quarter, and they don't think big picture. You're not going to make an investment that is going to make a large outlay right now, but maybe it could pay you 10 years down the road if all the market participants actually care about, which AKA that's what pays you, because executive compensation for S&P 500 companies is heavily tied to how the stock is actually doing. You're not going to make that investment. Instead of making that investment, you could just engage in more corporate buybacks. So I think that there is some real truth around the fact that we are so focused on these quarterly reports, and that management of these companies have to be so focused on the quarterly reports that they don't make the right investments for the bigger picture future. I think that there's something to be said about that. The problem is I don't know what the solution is to that. I don't know if all of a sudden just doing it twice a year instead of 4 times a year actually really makes that much of a difference. So I really don't know what the solution is, even if there's something that is, even if it seems accurate in terms of the thought process underneath the surface. From a trading perspective, we like the quarterly reports. They have the opportunity to shake the market up. They create a lot of trading opportunity. They create big movements up, big movements down, and that's what we want as traders. So as a pure trader, I don't want this to happen. But as an American patriot who wants the company to succeed, not just next quarter, but 10 years from now and 20 years from now, I don't hate the idea. I just don't know the right way to be able to implement it.
Yep. And Brant in the comments also saying, from a pure trading perspective, I enjoy the volatility 4 times a year that earnings provide, for sure. Because you need volatility to be trading versus investing, of course. All right. The China trade talks are also continuing for this market. We're in the second day of talks, part of those talks being a deal for TikTok. The rumored companies are either Oracle or Amazon that will be taking over TikTok. I could assume that either of those companies would get a nice boost on that news if it comes out that it's one of them. Maybe we could take a look at like the Oracle chart or the Amazon chart and see like what kind of targets you would be looking at, or et cetera, if it came to a TikTok deal for either of those companies, or if you think they're short.
Sure. Pull up the screen share if you want me to. These things are trading on other things right now that, I'll be honest with you, I don't know if the TikTok is going to make that huge of a difference. Oracle just is all over the place because of it just so recently had an earnings report. That earnings report had phenomenal forward guidance in there, but when you looked under the surface of it, I didn't think it was actually good enough to justify the whatever it was 40% move higher that it was on highs on that earnings report, because pretty much the forward revenue guidance is primarily coming from one deal with OpenAI, and that doesn't necessarily have to even happen. And OpenAI might not even be able to afford to do what they're planning on doing with Oracle. So the market then realized that the next day, and it sold it down a little bit. Look, TikTok is like the #1 platform, I think, in a lot of ways for social media, and almost more so than TikTok and Amazon. I would say that the question is, what does it mean for names like Meta, names like Snap, names like Reddit? And interestingly enough, we have primarily seen TikTok news move these social media stocks in pretty big ways. When it looked like there was a chance that TikTok might get fully banned, you were seeing big upticks come in every time there were headlines around it in Meta, in Snap. And the headlines this morning didn't seem to really move these stocks at all. If anything, you would think they'd be a negative for them because TikTok is going to continue to exist. But they must just be fully priced into the market at this point, because Meta is trading up and Snap is trading up. Snap is actually trying to break out on its daily chart here a little bit. So while this was a pretty big deal in the past for some of these other social media companies, it seems like it's turned into a non-event. And Oracle, I think, was already the #1 runner to kind of get their hands on TikTok for a long time. So it might also be priced into the stock a little bit, but it'd be hugely beneficial for Oracle. And obviously, Larry Ellison has close ties with Donald Trump, and I think that helps Oracle to secure TikTok.
All right, let's talk about Tesla. The news: Elon Musk bought about $1 billion worth of stock. That's his largest buy ever in the open market, especially after he has a long history of selling stock in the past few years. So I know based on your positions disclosure, are short Tesla. You've not a name you love. Knowing you, Derrick, you like to hate Tesla. So, with Musk's buy and the action today, what are your thoughts on Tesla here?
Oh, well, look, you can take a look at the stock in terms of a fundamental perspective, but the technicals are what rule. And even if I don't love Tesla, it doesn't mean I wasn't calling for the breakout buy at 355 2 trading sessions ago, because I was. There was this huge wedge here that got built out for many, many months in Tesla. A consolidation pattern here that we've been talking about the potential of a huge break higher or a huge break lower, depending on, which way the pattern actually breaks. Now we have that answer. It broke out. So, roughly speaking here, the measured move on this could be like $130 or something like that. So this, in theory, could bring Tesla, if the pattern were to fulfill itself, basically back to its all-time high. Now, I don't expect it to do that in a straight line. It's an insanely large move off of a pattern that took 1, 2, 3, 4, 5. It took 5.5 months to build the pattern out. I would not expect that Tesla's able to fulfill that pattern and get to all-time highs in 5 trading sessions. It tends to not be how the market works. With that said, if any stock was ever going to be able to do that, it would be Tesla, because it's the ultimate meme stock. The fundamentals obviously are still terrible, but the fundamentals have never actually mattered for this company. I called out a short in Tesla today. So I called out a long 2 trading sessions ago, again, on the break of the wedge, on this breakout 355 is what we had discussed. Today I called out a short. Called out a short really in the pre-market, but you still could have gotten some at the right at the open when we were trading around 425. Tesla gapping up 8% into 430 after having 2 big moves on this news, in my opinion, is way overdone in the short run, and the stock is extremely extended. And I'll tell you really what my thought process stems from is, so what is the importance of an insider buy? Just generally speaking, even if we're not talking about Tesla, but then we'll circle it back to Tesla. What's the importance of an insider buy? The importance of an insider buy is because your CEO or your executives at the company are coming in and they're taking a stand and they're saying, hey, we really believe in our company. We support our company. We think our company's at a great value here. So I'm taking my own money. I'm putting my money where my mouth is, and I'm buying stock. And the market likes that. The market likes those insider buys because they go, wow, okay, this is great. Clearly, the insiders, the executives of the company really believe in their own company, and they think that the price is really good here. They know more than I do. They think they're going to make money by buying right now, and it's bullish for the stock. And obviously, the exact same thing when we circle back to Tesla is true. Elon Musk coming in and buying his own stock absolutely is supportive of the stock. He's taking a stand. He's saying, I believe in my company. When it comes to Tesla and Elon specifically, some of the chatter for quite some time now has actually been more around his pay package and the importance of giving him this, personally, I think, obscenely high pay package, because Elon is that important and we need to incentivize him to stay at Tesla and focus on the company. They already approved, like a week or 2 ago, if he meets certain performance criteria, a $1 trillion pay package for Tesla. So in my mind, the insider buy is obviously important. It's important when it comes to any company, and this was a particularly big one from Tesla. But I think that the fact that they already offered him the $1 trillion pay package already means that he has enough incentive where he's not going anywhere. So the insider buy in and of itself, I don't actually think changes very much. And then when you couple that with what we call technical extension, going back to the chart, 2 huge up days in a row, big up day on Thursday, further continuation on Friday, which was when he was actually buying stock. And then on top of that, I get a huge gap up to pre-market 430 this morning. This stock just went $80 in 2 days and a gap up. To me, that's a sell the news short in the short term. In the big term, like I said, this thing just broke out a pattern that technically has continuation up to 480, 490. Technically has continuation up to all-time highs. So this is a stock that you probably want to keep on your radar for buying dips, for buying bull flags, bull wedges, buying that next trading setup, but not buying it on a day 3, 8% gap up into 430 on news that I don't think is really that dramatically important when all is said and done, with an ADMA on the daily chart that's still at 373. There's just too much extension there. So in the short run, that's why I was calling this out for a short, for a pullback to 410. Maybe we could see a pullback to 400 or even a little bit below 400 over the course of the next few days, especially if the market were to sell on the Fed. But beyond that, then you want to be looking to see how does the stock correct this upside extension through time or price for the next buy setup for the next leg higher. And you stick with that until the technicals show you something different. And right now you have a chart that is super bullish, completely broken out, just too extended.
All right. While we're here on a stock that you are short, let's answer this question from a viewer. I'd like to know how you manage your shorts, many of which you've held for a while and they've gone against you. How do you manage the capital to add to your short as it continues to go against your short convictions?
Sure. So the key to that is position sizing, which happens via game planning. I have a whole number of different types of trades I take and game plans and styles of trading. But if you see me in a position where I'm in it and it's going against me and I'm still in it, it means that my sizing is appropriate for that. And the game plan from the beginning was to take more of a build into it approach with the stock, which is what I'm doing now. I'm fully recognizing that this market, as I said earlier, is in a buy the rumor, I think sell the news event when it comes to the Fed. So I actually was expecting my short swings to continue to move against me today. And all I'm doing in that situation is actually building into them further via my game plans. So again, it comes back to sizing versus space, right? When it comes to then how you're game planning for any particular trade. If you have a massive amount of size and the stock goes against you a little bit, then you're in a lot of trouble. If you have a small amount of size and the stock goes against you a little bit, and obviously this is all relative per trader and per account size and everything else, if you have a small amount of size or smaller amount of size and the stock is moving against you, you're not really getting hurt by that, and you have a lot of flexibility on what you can do. At the same time as that, I implement a game planning approach to the market where I draw out cash flow on a day-to-day basis intraday while the bigger picture either works or does not. So what ends up happening is if I have trades that are going against me, the open P&L loss of the short, in this case going against me, is being cushioned by the fact that I'm able to trade around the position day in, day out, where I'm actually making some money in the process of making money in the small run, in the process of losing money in the big run. And then if I can, the way that I like to describe the way my game plans work, if we want to talk about the short side, is if it goes down, I'm going to make money because I'm short, obviously. If it goes sideways, I'm going to make money because of my game plans and because of how I approach it. If it goes against me, if it goes up in this case, then yeah, I will lose money, but I'm losing money in a way that is cushioned by the amount of money that I'm making intraday. So I'll lose money. I might not even lose money, to be honest. It depends on the rate of acceleration. If I'm short Tesla and Tesla just does what it did, and I'm short the whole way, I'm obviously going to be losing money. But if I'm sure how Palantir has been trading more recently, or how NVIDIA has been trading more recently, where they've been significantly more range bound, but then starting to move up a little bit, there's a good chance that those positions are going against me, and I'm even continuing to make money in them. So, I mean, I'm just such a believer in the importance of game planning, but game planning really has to include what you can afford from a risk perspective. And I feel like I've developed these game plans now where I can make money in trades when my trades work. When my trades are going sideways, so they're not working and they're not failing, it still becomes a win for me. And again, even when the trade is going against me, as long as the sizing is appropriate and the rate of acceleration against me isn't too bad, I actually will still make money. And again, it's all a function of what I think are the most important fundamental things when it comes to trading, which is sizing, risk, space, and that is then all manifested in the game plans that you're developing for those trades.
And a comment from YouTube to whoever came up with the "Got Liquidity" shirt, bunch of fire emojis. That's a T3 Trading Group shirt right there. All right. One thing I didn't get your opinion on, we talked a little bit about China and the Oracle, Amazon, TikTok, all of that. We didn't talk about China and NVIDIA. NVIDIA was down quite a bit after China said they violated anti-monopoly laws after a preliminary investigation. But I mean, clawed back most of those losses down just 0.07% now, compared to, I think, over 2% earlier this morning. So do you think it means much for NVIDIA long term, this China news, or?
Yeah. So NVIDIA is in an interesting spot. Obviously now, technically it's just been going sideways for 2 full months now in this 165 to 185 range. But Tesla's NVIDIA is in an interesting spot because you had that news hit this morning, which was a negative. And on the surface of it, even pre-market, I was saying to the team, I was like, you would think that NVIDIA would be down even more on this. But the counter argument on that is that this is just all part of the negotiating tactics on the trade war. And what the market is actually, I think, pricing in the reason why it wasn't down more this morning, and the reason why it was able to claw back all the smaller losses that it even had, was I think that the market is pricing in a degree of Trump allowing the Blackwell chips to be sold by NVIDIA to China in some of those negotiations, right? Like currently, we've made it so that NVIDIA can sell the H20s to China as long as the US government gets 15% of the exports on the way out, which I think is technically not constitutional, but it's neither here nor there. But China doesn't need the H20s. Those chips are old. And I think at this point, China's own internal chip technology is probably as good as those H20s. The best out there is the Blackwell stuff. So the market's pricing in that Trump is going to allow for at least a dumbed down version of the Blackwells to be sold to China. That's what's being priced in at this point. What I don't think that the market's doing a good enough of job pricing in is that all of this trade war stuff, and Jensen Huang has talked about this extensively himself, and I think he's 100% correct. And I actually think it's too late at this point. All of this trade war stuff, and when it comes to the chips, it started with Biden and continued through with Trump. So it's from both sides of them. All of this anti-competitive, anti-capitalist stuff that we do hurts us. It hurts us because it just incentivizes China to go and do everything they possibly can to catch up on the technology. And they're going to get there. In my mind, there is no doubt that, I just don't know how long it's going to take, that the Chinese are going to catch up to the United States' technology and eventually surpass it. They have a much higher population than we do, but all of the highest level PhDs in China were educated in the United States. They all got educated here. And this has been something that I have been complaining about for 15 years. My entire time that I've been running a trading desk at T3, I have especially a long time ago when my desk was newer, I was bringing on all these like entry-level traders onto my trading floor at T3 who are graduating, who are from China, who are from India, who are from other countries, who are coming to the United States, going to our top universities, going to Ivy League universities, graduating with master's degrees, graduating from PhDs, and we made it impossible for them to stay here. We need to make sure that when the best and brightest people in the entire world want to come to the United States because of all the amazing things that we have here in terms of culture and innovation and everything, that the best and the brightest in the whole world should be able to stay and work and innovate here. And that has not been the immigration policy of the United States, regardless of Republican or Democrat or any of that stuff, for well over 10 years now. And I could tell you with firsthand knowledge that I was bringing on extremely intelligent people who are going to be successful in life onto my trading desk, going back the last 10 plus years now, after they were getting phenomenal educations. And then I couldn't keep them. I couldn't keep them here. So they go back to China, they go back to India, they go back to wherever they came from. And what are they going to do? They're going to go back to their home country and just give up? Like, okay, it was great. I got to go to the United States. I got to get my PhD in financial engineering, but now I'm just going to give up because I couldn't stay in the United States. No, they're gonna take everything that they learned here, and they're going to innovate, and that's it. So they just have the entire government now pushing internally to get people who were educated in the United States to do everything they can to catch up to the United States. It's going to happen. And then when you combine that with the trade war activity, it just incentivizes them to not want to buy from us. They're going to buy, the Chinese will buy NVIDIA chips for as long as they have to. They only will have to when we are willing to sell them a better product than they're able to produce on their own. And if we're either not willing to sell it to them, then there's going to be no sales. Or if they have a product that's equally as good, there's going to be no sales. So I personally think that at this point, there's a lot of risk to the downside on the AI trade. There's some statistics I was reading over the weekend that show just like very, very high, I don't remember the exact numbers, but like ownership of infotech and particularly AI and semiconductors versus on a historical basis. Everybody owns these things. They have to work perfect in order for them to continue. I don't necessarily think that they will act perfect. And to me, it's still a huge negative that 39% of NVIDIA's revenues come from 2 companies. So to me, I see a lot of risk to the downside in these names right now. I think that we are in a bubble because of these names, but are we in 1995, 1998, or 1999? You know, your guess is as good as mine because the bubble can continue to inflate.
All right. Like a good Derrick rant about things. All right. From YouTube, and then I'll let you go. We got a question. Somebody wants you to look at SMR, which is New Scale Power Corporation, I'm pretty sure.
Sure. It looks okay. I actually feel like it should be performing better. So what I want to say, if I'm just looking at this chart in a vacuum, is it looks decent. If it can hold above 36.50 and if it can continue through 38 in particular, 38 has some resistance, I think that this thing looks decent for upside continuation. But we can't look at stocks in a vacuum. We have to look at it in conjunction with everything else. And when I look at it in conjunction with everything else, the question I would have is, why hasn't it gone already? Everything else is gone already. Everything else is continuing. It's extending. The market's continuing. It's extending. And this is not. So why is there relative weakness there? That gives me pause on putting a new long on in this chart, especially when I have broader concerns that the market could begin to have a sell-off in the back half of September and possibly through October. So again, in a vacuum, I think it looks pretty good, especially if it could get above 38, but we aren't in a vacuum, so I wouldn't buy it. We should look at some of the competitors too, right? Like what's OKLO? Yeah, like look at OKLO extending. Why isn't SMR going like OKLO is extending? What's the other one? Is it NEE? No, I don't think that's right. NNE? Yeah, NNE. This one's starting to break out also. I think that this one actually looks a little bit better than SMR. Look, because it broke through 34, has some resistance, 34.60-ish has some resistance. So I actually think that both NNE and OKLO look better. OKLO, though, is 100% chasing. And again, when it comes to SMR, it's just lagging so much that I would get concerned that there's relative weakness there for a reason. And if the market sells off, then you're going to have no chance of this really going.
All right. Thanks, Derrick. All right. I'm going to let you go. Derrick is a real trader, so I want to let him get back to that. If you'd like to get his free ebook, you can go to t3live.com/DOLive. It's ebook about the benefits of prop trading, how you can work with Derrick himself there at T3 Trading Group. So again, that's t3live.com/DOLive. Derrick, have a great rest of your trading day. We're only 2 days away from the big event of the week. So hope you get some good catalysts and volatility heading into that. And it's a good Fed day for you. Have a good one.
Thanks, Greta. See you soon.